Alrighty, good morning, ladies and gentlemen. Welcome to MACROACE with your host, Tony. So, non-farm payrolls, we've got about 30 minutes. No, I won't tell you to buy or sell. So what this is all about with the live streams is to give you a background, just give some information about what the release is about, what's happened in the past, what is the sentiment, what are investment banks thinking about the release, what do they expect, and what have central bank members said, and then leave you guys to work it out for yourselves as to what you want to do with your trade. If I was to say buy or sell, I'd probably be hated if it went wrong. So I ain't taking that risk. No way. It's Friday too. I don't want a stressful day. I just want it. I want a nice end to the week, as I'm sure you guys do too. Alrighty. So non-farm payrolls. Let's get into it then. So what is it? It represents the net amount of jobs created in the prior month. And you have the household survey and establishment survey. The household survey represents the unemployment rate, and the establishment survey is where they ask different businesses from 629,000 corporate and government work sites of how many people they have on their payrolls. So how does it affect the markets? Nice and simple. Stronger than expected payrolls data is bullish for the dollar because it could mean that rates will stay high or stay where they are for longer, or in a normal market environment that the US economy is doing well and the job market is doing well and is nice and healthy. So that means that more spending is going to occur in the future, and then in turn hopefully lead to a better productivity rate within the US and better GDP data. However, on the flip side, for the stock market in the current environment, it's if you do have stronger employment data. We've seen in the past, actually with the last release, which I wasn't there for, but stronger than expected employment data can lead to the stock market taking a hit, because it means in this environment, the central bank will probably hold off on cutting interest rates. So if you do get continuous strings of strong employment data, then that puts the Fed in a tougher spot. And also then the markets start to speculate and readjust their bets for what the central bank might do. And in this case, they could decide to say, right, okay, maybe there is going to be no rate cuts this year at all. But the more likely scenario is that the current expectation, if it's November or September, which is kind of a mix between that now, more towards November, with US rate futures traders expecting November as the first rate cut, then stronger than expected non-farm payrolls data would see that short amount of volatility, see markets pricing in the stronger chance of November, and maybe a very small chance of maybe the rate cut being pushed back to December instead. The inflation data is what really moves the markets, because that's what the central bank is focused on. Non-farm payrolls, yes, it's important and can move bets for rate expectations for the Federal Reserve, but not as much as CPI, because that's the big dog at the moment. We're still having issues in the US with that there, not getting towards the 2% goal. For bonds, a weaker than expected report for bond yields, okay? Or bond yields usually see, if you do get weaker than expected report, that means that if the dollar goes down, bond yields will also go down too, because that means that rates might also come down quicker rather than later. And if the interest rates expectations also go, if they expect a rate cut sooner rather than later, the yield on those bonds also start to go down and are impacted in anticipation of sooner than expected rate cuts, or maybe pushing back, or maybe pulling back to an earlier date or an earlier month for a rate cut instead of a later month, or nothing this year at all. Right. So indicators that are weighing on sentiment at the moment. How is the market being affected? What could affect the data today? So you had inflation, that's 3.5% compared to 3.2. PC price index year on year 2.7% compared to 2.5. GDP final, that should be a GDP. That's the GDP advance. So GDP advance for Q1 at 1.6% compared to Q3 of 3.4. Q4 of 3.4. Sorry. And ISM manufacturing employment at 48.6 compared to 47.4. Then manufacturing PMI 49.2 compared to 50.3. Services employment, ISM services employment at 48.5 compared to 48. ISM services PMI 51.4 compared to 52.6. JOLTS data that we had this week at 8.488 million compared to 8.756 million. Employment costs at 1.2% compared to 0.9%. ADP employment change was at 192k compared to 208k. And average earnings year on year last time around was at 4.1% compared to 4.3%. So if we're looking at the current triggers then for the data today, forecast at 240k is what the median forecast is, what economists are looking at. And then if we're looking at the high and low estimates, markets, where economists are looking at a high overall of 280k and a low estimate of 150k. So the deviations you're looking at on the high end is 40k and on the low end 90k. Average earnings expected to with a high estimate of 4.2% and a low estimate of 3.9%. So a deviation of 0.2% on the high end and 0.1% on the low end. Unemployment rate 0.1% deviation on both sides, and private payrolls the inverse of non-farm at 90k on the high end and 40k on the low end. Now, if you have access to the MACROACE ranges and deviations sheet, you'll be able to see this all the time. You won't have to wait to see this image appear here or look at the past historical data, which is what we do here in MACROACE, is to show you the past data of how the markets have been affected by certain economic releases. I'll show you that in a little bit and I'll go into a bit more detail, but that's the whole gist of it. All right. So if we look at the previous report then in February on March, going back to last month in April, government added, so there were 71,000 jobs added in government, healthcare 72k, leisure and hospitality 49, social assistance +9, other services +16, construction 39k, and retail trade +19k. So if we're looking at Fed and government views then, so we had Fed's Powell on the 2nd of May that said the labour market remains relatively tight and nominal wage growth has eased over the past year, but the labour demand still exceeds supply. Also from Powell on April 16th, he said that labour market is moving into better balance even amidst ongoing strength. Goresby on April 19th said that we have done great on the employment mandate, but we have not succeeded on the inflation mandate. Bostic said that we can keep rates steady as long as the labour market holds up. Williams also said on that day that if data called for higher rates, the Fed would hike. That's not just including inflation, that's with the CPI and PC and other inflationary bits of data, but that also includes the employment data too. Fed's Daily said that upside surprises in labour force supply, but can't rely on it for policy making. Now the key thing is, if you do get a report here and there where employment data, it's a lagging indicator, the data for non-farm payrolls, but if the employment data continuously sees a strong rise month on month, then that will change the view of the Federal Reserve and maybe make them even more hawkish in their expectations of when they would cut interest rates, and maybe push it out to next year instead. Fed's Collins says that I am seeing much less reason for concern in the labour market. Now, investment bank views and research. So you had Nomura on 29th of April said that labour data is likely to show, or labour data are likely to show a gradual deceleration in job gains and wages. They see 255k, which will be the lowest reading since last November. Morgan Stanley, they forecast 250k and private payrolls at 200k. Other labour indicators have been strong, but we allow for some reversal in recent retail payrolls, being strong despite soft goods spending, and some payback for a warm winter. Goldman Sachs forecasts a non-farm payrolls at 275k. Then CIBC, they see 200k. They are below consensus for payrolls, but nonetheless expect solid job growth driven by sectors somewhat less sensitive to their business cycle. Job growth consistently below 150k mark, combined with participation rate that either stalls or edges down, is when the Fed will be concerned that the labour market could be at risk of moving into excess supply. What does excess supply mean? Well, that's when, or what you call slack. That's when there are fewer jobs and more candidates that are available. Okay, then you have a tight labor market, which is the opposite of that. So you have more jobs that are open, but fewer candidates because they're looking for they're looking for a job that's going to pay them a better rate, and they're more or less secure and in their finances, and they've got more security. Bank of America say that they forecast a 250k increase in May non-farm payrolls, private payrolls at 200k, with initial jobless claims low, moving sideways. They don't expect the recent momentum in the labour market to slow, and that was on the 30th of April. So the highest estimate that we can see there, from what I cherry picked, is from Goldman Sachs at 275k. Everyone else is around that 200k to 250k range. So let's go to, now of course I wasn't here last time around for the data, but we'll have a look at the deviation sheet, and that'll give you more of an understanding as to what this deviation sheet is all about. What does it mean? What are you talking about, Tony? You're confusing the heck out of me. So the deviation and ranges spreadsheet, it shows you how the markets have reacted to economic releases in the past. Okay, and it gives you a view number. So you have 10-minute market reaction, the initial market reaction, and a market reaction 30 minutes after the economic release has occurred. So here, we have the initial. So here, if you can see this figure, this box, looking at the S&P 500 on looking at non-farm payrolls last time around, you can see here that there was 84, the initial market reaction going to the wick of the candle. Okay, there's an initial 84 tick move towards the downside, and this black bracket shows you the movement 10 minutes after the release has occurred. If it doesn't have, you can see it was still down, but there was a bit of a reversal, but it was still down by 13 ticks. One thing to remember, if let's say it says here that it says 84 ticks down, and then here it says 13 ticks up. If you do see, let's say if you do see one of these words in the black bracket or the blue bracket, it means that there's been a reversal. Okay, so again, if there's 84 ticks down and in one of the brackets it says up, then that means that there was a reversal. But if you don't see that, that means it's moving in the same It's still below the level prior to the economic release. So you can see here the market reaction wasn't really that strong. So post 30 minutes, which is represented in the blue brackets here, the S&P was still down, but by 9 ticks, and that's with an 89k deviation on the economic release. So if we're looking at the other areas too, the Nasdaq saw its biggest market reaction since October on the initial market reaction. Okay, about 403 ticks down, but it did make a reversal here after about 30 minutes of trading. Actually, quite quickly in the 10-minute space that it had. So it was still down by 17 ticks, but it had clawed that back, and after about 30 minutes of trading, it was up by 37 ticks. Okay, so the strongest currency pair that we can see here that's had the biggest market reaction last time round was on cable instead. Usually it's been the dollar yen, but now that we're into this space where the yen is seeing, or the Bank of Japan already hiking interest rates and looking to hike interest rates, not as often as what the Federal Reserve or any other central bank has done, being very conservative about their hiking path. The last report here back in April, cable was had seen the strongest market reaction, or the biggest move compared to all the other currency pairs. But it doesn't mean you can't keep that out of the way and not focus on it, or keep it on your mind. The euro dollar, and then you have you have dollar CAD, euro dollar. You have the Aussie dollar, okay, and then you have the dollar yen. So in order of importance that they move, or that this is in the order of importance that you can see of what's going to have the biggest move. So again, cable, dollar CAD, Aussie dollar, euro dollar, and dollar yen. Okay, so those are the ones to keep an eye out for. All right, and then if we're looking at the bonds, so the bond areas of 2 year with a ZT, 2 year bond futures in the US, that has seen the biggest market reaction out of the two because it's the most sensitive to what's going on within the economy and the ups and downs of the business cycle. So 2-year bonds had seen 30 ticks down initially, and after about 10 minutes of trading, it was still down. Didn't really move too much if compared to what we've seen in other asset classes. So it's been a bit more solid compared to everywhere else. Gold had seen 126 ticks down, and then clawed back some of that decline, but was still down by 99 ticks, and after about 30 minutes, down by 51 ticks still, and hadn't recovered or hadn't reversed its initial move entirely after 30 minutes. But you can see everywhere else, the currency pairs compared to the indexes had a bit more stability in regards to, you didn't see so much of a big old choppy reaction, or quicker, you didn't see as quick a reversal compared to the indexes. So that's also another thing, just to, again, this is why it's useful to know where should you go. Are you going to take the bigger risk and go into the indexes, or do you want to which currency pair you're going to go into, depending on how it performed last time. That's the whole beauty of this spreadsheet, is to tell you how the markets have reacted to the economic releases in the past. Then you can plan yourself, right? It's not we're not telling you, how to trade, or what how to buy or sell, or what level to go out here or there, or giving you signals or stuff like that. No, we'll give you the information, give you the what you need to understand, the basic fundamentals of what you need to know. And the more prepared you are, the better informed you are. And then, of course, you make your own decision as to what you want to do with that information. So that's the beauty of it. We just take down how the markets have reacted. Just to also, for anyone who has seen the deviation sheet before, we have also added in the previous column as well to the macro to the spreadsheet. So I guess one of the first things, this stuff is evolving. This product that we have, it's evolving over time. It's getting better. Hopefully, you guys are enjoying it, and you guys are liking this information. Yeah, I can see questions about people asking how do they get their hands on it. Well, all you've got to do is submit to this, or submit. Jeez, that sounds a bit archaic. All you got to do is sign up to the MACROACE mailing list there, and then Monday you'll get access to the deviations and ranges sheet, and that's completely free. Okay, so McTavish. Yeah, why not? But yeah, so that's completely free to have a little look at. Please let me know what your thoughts are of the ranges and deviations sheet. Is it useful, or what is it? I know there have been suggestions of what we can do to improve it. Yes, with providing a market profile, we're looking to get it up on a platform, get its own sites, so we can add some other cool things to it and then make it look really nice and fancy, rather than having to look at a spreadsheet, which would be much better. All right, so let me get this up here. Also, one more thing before we, if anyone didn't make any notes of it, so here we go. So yeah, non-farm looking at a high estimate of 280k, or high deviation of 40k, and a low deviation of 90k, or 40k difference and a 90k difference. A high estimate of 280, a low 150. Those are going to be, these are going to be the prime figures here. So here you'll see where the ranges and deviations are set or open for the week ahead, and then remove them, of course, because they're done on this side here. Okay, you can see that I have added in some other economic releases: New Zealand CPI, Australian CPI quote-unquote data, UK CPI. We're starting to add in some of the more other international economic releases as well. I think I also added in the employment cost index as well from the data that we had this week. Looked pretty good. Yeah, but so it's starting to add more, some of the more other international economic releases to the spreadsheet. Okay. Are we all clear on what we're looking for? So again, high estimate 208k, low estimate 150, a deviation of 40k, and a low estimate of 90k. Mungabulnavest. I've signed up a few times but never received anything. Send me an email to tony@financialjuice.com, and I'll see why you're not receiving an email. You should do. Walados. Dude, you're going to make that decision yourself, whether to buy and sell. I've provided the information now. You've got to make, your first. You've got to make your informed decision on that. I can't tell you whether to buy or sell, buddy. I'm not. Yeah, that's not the right way for me to go about it. If I did that, yeah, that's the beauty of trading. You gotta learn. So you gotta get the information have the information that you need, and then make your own choice as to what you gonna do, brother. Right. So I'm gonna get myself set up on here with the website and the charts. So if you've just seen that appear on the screen, I've got TICKSTRIKE up and running. So TICKSTRIKE, what it allows you to do is it shows you the strength within. It shows you the strength and the buying and selling momentum of that asset via a voice, via sound, and visually. Okay, and that's done through this ticker box here. This box, which you should see me dragging around and moving around there. Okay. All right, I'll explain that a little bit. We're looking at FinancialJuice. So if you haven't heard of FinancialJuice or never come across it, if it's your first time looking at FinancialJuice, then FinancialJuice is a live voice and text service keeping you up to date with what's going on within the markets and what to, if there's a certain headline that's come through or an economic release has happened, or maybe Powell has said something that's rocked the market, or a Fed speaker said something, then you'll be in the know of what's going on within the markets live there and then in real time via voice and text. On the left-hand side, you have your economic calendar of the schedule for the week ahead of economic releases. Again, that's also live in real time too. So when the data comes out, bang, it's there. So again, as I said, you have your news feed over the text headlines in the center here of the voice that we say on of the things that we say on the microphone. And if you've never come across FinancialJuice before, then you can still sign up to the light version of FinancialJuice. The light version of FinancialJuice, it does have a delay. There are adverts that are played, but if it's a first time coming across a live voice and text service and you don't know how to kind of incorporate it, you're not really sure if you understand it that well, or maybe you've kind of been a bit pessimistic in the past, have a play with the light version. Yes, there is a bit of a delay, but it will give you an understanding as to what you could expect from a live voice and text service with the news. Now, if you feel confident that you want to purchase the pro version of FinancialJuice, I've got about 41 seconds. I'll tell you what, I'm going to wait until the release is over, and then I'll talk about FinancialJuice in a bit more detail. But I'll just post a link here with the FinancialJuice Pro, which we have an offer at the moment where you can get FinancialJuice Pro for $99 for the year rather than paying $1,200, which is there with the Juicy 92 code, the promo code, which should work there. Right, we've got a minute. I'm going to go radio silent to make sure I prepared myself, and then I should sashimi? Oh yes, I do see. I'm affiliate. How to get access to TICKSTRIKE and unusual activity? Can you help me out? If you email Amar at financialjuice.com, he will be able to help you out with his stuff and go through that there. So Amar at financialjuice.com. Okay, are we all clear on the ranges and deviations? Are we all set? Again, I'm like I said before, it's all down to you. What do you guys do? All right. Okay, I'm gonna go quiet. 10 seconds. Taking 2 trades in the moment. Luckily, they've all been good. Took one buy, and I think if we're looking at TICKSTRIKE, that's the try and close it there. All right. Okay, so that selling momentum's coming in as a little bit of a risky touch in with the NQ there with the selling, but 2 trades before that, which were good. So initial trade was a buy, then there was a sell. Well, let me put a draw. There's a little line. And so sell around here. There was a movement beforehand though, before the data had come out. So also don't forget, if you liked the video and you found it useful, don't forget to share the video and subscribe. Deviation, so didn't reach the low point, but 175k compared to 240k. So let's get this in here. Let's see. Just gonna check. Yeah, so that was about a 65k deviation there on the low end. Okay. Other bits of data, average earnings year on year was also down. That's also a good sign. Okay, TICKSTRIKE showing that there's more selling momentum that's creeping in instead after that initial move. Manufacturing payrolls, nah, doesn't really matter too much. So a weaker than expected report. Still see a bit of that buying momentum coming in. Data is better for the stock markets overall compared to what we've had in the past. Let's do a measurement and see what else we got. The momentum though. Okay, that's pretty big. Let's leave that there. See how that plays out. One more and then we are done. See if we can push it a little bit further. See. All right, so US Fed Fund futures raise a chance of a rate cut in September to 78% after jobs data compared to just 63% before. All right, money markets are expecting more rate cuts from the ECB. Okay, I think that's, you know what, that's kind of done. So I'm not getting too much movement. So it's probably the last. I'll get out of it. There's no point sticking around now. All right, cool. So 3 good trades, 1 just kind of hovering around. Not much momentum happening now, so I will call it an end to the day with that there. Other than that, yeah, we'll just measure to see how well it's how well it does in about 30 minutes time. All right. Anyways, so if you guys found that live stream useful, if you found the information useful, don't forget to subscribe to the FinancialJuice channel. Give the video a like, share it with your fellow friends and traders if you found it useful as well. And also, I will see you guys. So next week we have the Bank of England interest rate decision. We'll also, in the ranges and deviations sheet, I'll cover what I'll also put in is the RBA rate decision and how that affects the Aussie dollar and the market into the ranges and deviation sheet into that sheet there. What else do we have? Yeah, other than that, and Canadian employment change data as well on the Friday. So I'll be covering that too. Okay, so thank you very much for joining me live. And as said, for FinancialJuice, if you want to sign up to the, let me find that here. So as said, we have the current offer for FinancialJuice at $99 for the year rather than paying $1,200. So you get a 92% discount on FinancialJuice. You can, as said, you can sign up to that with the link there. Make sure you have an account first on FinancialJuice, and that you've once you've made sure you do have an account on FinancialJuice and you've got login details on the light version of FinancialJuice, then sign up to the pro version, and you can do that. There'll be like a little button here or around. You can see where I'm kind of click on the sidebar. There'll be a little button on the left hand side there that will show you where you can that will show you to the link to buy FinancialJuice Pro. Remember, the Pro version, there is no delay. It's live and in real time with the economic release data points and also the headlines and voice. Again, all in one place to keep you up to date with what's going on. All right, US rate futures now priced in 2 cuts of 25 basis points this year compared to 1 before the jobs data. All right, so that's a bit of a positive. That's there. All right, so a little bit of a relief for the markets so far. All right, so I will see you guys on Thursday for Bank of England, and that'll be in the live stream early in the morning. And yeah, other than that, I will thank you very much for joining me live. Don't forget to give the video a like, share it, subscribe to the channel, and I will see you guys next time. Okay.